Just a few weeks ago, a lot of investors honestly thought the market was going to crash. We were looking at massive new tariffs, escalating tensions in the Middle East, and soaring inflation data. And yet, completely defying gravity, the SPY ETF just shattered its all-time high. So what is actually happening out there? Well, in this explainer, we're going to decode exactly why the market is behaving this way, and more importantly, what it means for you. Okay, let's dive right into this, because that is the million-dollar question right now, literally. Today, we're going to unpack the core mystery of this historic moment. I promise we'll uncover both the massive, high-tech engines driving this record-breaking rally and the hidden macroeconomic traps lurking just beneath the surface that you absolutely need to know about. Here's a quick roadmap of where we're headed. We'll start with the basics of the SPY, unpack the exact numbers behind this 2026 all-time high, and analyze the market drivers. Then we'll pivot to the warning signs, review Wall Street's split perspectives, and end with some golden rules for investing today. Part 1. What is the SPY? Understanding the world's most famous ETF. So, for those who might need a quick refresher, the SPY is the most famous exchange-traded fund in the world. Think of it as a single basket holding the 500 largest companies in the United States. You've got giants like Apple, Microsoft, Nvidia, Amazon, Google, and 495 others all in one place for a tiny 0.09% annual fee. When the SPY hits an all-time high, it basically means the whole team is winning. It's kind of like a national football team taking the World Cup. It reflects the overall health and peak performance of the U.S. economy. And historically, since 1970, this team has returned an incredible average of 11.2% annually. Part 2. The 2026 all-time high. Let's look at the numbers behind the record. The magic number here is $752.13. On May 26, 2026, the SPY hit that absolutely unbelievable intraday 52-week high, closing the day at $750.59. And just for some context, the broader S&P 500 index itself reached a massive record of 7,549 points. These aren't just incremental bumps, these are monumental historical milestones. And the immediate catalyst that pushed us over the edge? A massive tech rally that minted a brand new member of the highly exclusive $1 trillion club, a threshold only a handful of companies have ever crossed. Micron technology jumped a phenomenal 19% in a single day. Alongside that, we saw Qualcomm surging on reports of a massive AI chip deal with ByteDance. The momentum in the market was just electric. But getting here, man, it was a chronological roller coaster. Back in April 2025, after the announcement of massive new tariffs on what was called Liberation Day, the market plunged 10% in just 3 sessions. By the end of 2025, however, driven by a really strong 13.6% growth in corporate earnings, the S&P recovered to near 6,900. Then in Q1 of 2026, we hit another 10% correction tied to geopolitical tensions in Iran and oil spikes. And finally, climbing out of that dip, we reached our historic May 2026 all-time high. It just shows incredible resilience.
Moving on to part 3, the market drivers. What exactly is fueling this massive rally?
Now, what's really interesting about this is we're seeing the rare convergence of 4 distinct catalysts happening all at once. First, the unstoppable momentum of AI and semiconductors. Second, geopolitical easing, specifically some positive notes regarding Iran negotiations. Third, the Federal Reserve. Not only have we seen rate cuts, but the Fed is quietly reinvesting maturing short-term Treasury bonds, acting as a sort of stealth quantitative easing. And fourth, solid corporate earnings, with heavyweights like Apple thoroughly beating Q2 expectations. Let's zoom in on that first driver for a second, because the sheer magnitude of the AI catalyst cannot be overstated. Get this, UBS actually tripled Micron's price target to $1,625. Why? Because there is a very real, very tangible shortage of high bandwidth memory, or HBM. Micron's entire HBM production for 2026 is completely sold out, and they've locked in prices with multi-year contracts. This isn't just market hype, folks. It is locked in, sold out revenue, pushing the entire market upward. Which brings us to part 4, 4 warning signs. The hidden traps beneath the surface. We are facing a stark contrast right now.
On one side, extreme market euphoria, bullish optimism, with Goldman Sachs pointing to a 7,600 S&P target. But on the exact same day, bearish realities are staring us right in the face. Wholesale inflation hitting multi-year highs, and the 10-year Treasury yield sitting uncomfortably at 4.47%. We have to objectively balance this euphoria against very stubborn, very real macroeconomic headwinds. So let's detail these 4 specific alarms. Number 1, April saw an unexpected spike in wholesale inflation, hitting a 3-year high. Number 2, interest rates are still elevated, with the 30-year Treasury hovering around 4.9%, and high rates act like gravity on stock prices. Number 3, oil volatility. We've seen wild swings in the Strait of Hormuz, pushing WTI crude back toward $90 a barrel, threatening to reignite inflation. And number 4, crucially, declining net buying volume. Technical analysts are seeing a divergence. While the price hits all-time highs, the buying volume has actually been exhausting since April 20th. This is a classic short-term warning sign.
Part 5, Wall Street Perspectives. Let's see what the big banks are saying.
And this brilliantly illustrates the massive divide happening right now. Goldman Sachs remains firmly bullish, eyeing that 7,600 target backed by 12% earnings growth. They see a sustainable, broad-based recovery. Morgan Stanley is also bullish, leaning heavily on the expectation of Federal Reserve rate cuts and fiscal policy support. But then we impartially look at these skeptical economists who are decidedly bearish. They're warning that the market is running on excessive optimism, pointing out that the United States is currently sitting on the highest effective tariff rate since 1939. 2 very different realities being debated at the very top of Wall Street.
Finally, Part 6, Rules for Investing Today. Let's talk about how to protect your portfolio.
Rule number 1, dollar cost averaging. If you're buying at all-time highs, please don't dump all your money in at once. Spread your purchases out over time to average your entry price. Rule number 2, maintain a 3+ year horizon. If you need your money next year, this is definitely not the time to bet the farm. Historical data shows buying at all-time highs works out, but only if you have the runway to wait out the inevitable dips. And rule number 3, keep cash liquidity. Having cash on hand means that if those geopolitical or inflation-driven corrections we talked about do hit, you are ready to buy the dip strategically rather than panicking.
So, what does this all mean for you? Look, the market always goes up and down. Are you prepared for both scenarios? Remember, the purpose of this explainer is strictly educational, so always consult a certified financial advisor before making your moves. But I hope this breakdown has empowered you to evaluate your own portfolio with a clear head. The SPY's historical run is a fascinating case study of modern economics, fueled by unbelievable leaps in AI and complicated by intense global pressures. Stay focused, stay prepared, and keep learning. I'll see you in our next explainer.